All right, we're going to get going. As we all know, I like to run a meeting on time, so we're going to kick it off. And I'd like to introduce myself. I am Maren Brisson-Kuster. Unfortunately, I don't get to see you all in person today. I am your current 2020 NC Realtors president, and I myself hail from Charlotte, North Carolina. And I am proud to have one of my favorite speakers here with us today. So before I intro him really quickly, I want to go through some housekeeping items with you. If you have any technical difficulties throughout this meeting, make sure to contact the tech hotline. And that number is posted in your chat. But also make sure to ask in that chat if you need it again and cannot find it. All right. So I appreciate everybody putting in your cities into the chat when you've been logging in. It's been awesome to see. We've got people from all across the state here, and I don't blame them because you are here to see Dr. Yun. He is amazing. He is one of the best economists in this country, and I'm not just saying it because I'm a big fan of his. He truly is. He has led the charge at NAR for years on the economy, and he knows everything about it. And he's here to tell us today really where we are right now and what he expects to see coming and what he really looks at and sees for North Carolina. And he's going to give us some statistics that you guys are going to want to take down. But no worries if you don't write fast enough, because we are going to record this session and post a link for you on the NC Realtors website. Now, Dr. Yun's full bio is on NAR's website, which is nar.realtors.org. But I'm not going to bore you with all that because really I'm excited to hear what he has to say. I haven't met with him for a couple months now, and I want to hear what he's got. So with that, I'm going to turn the meeting on over. And if you guys have any questions going forward, please post them in the chat. All right. Thanks. And it's all yours, Dr. Yun.
Thank you, President Maren, for introducing me, inviting me, and also for Realtors in North Carolina. Please be mindful that the president of the state association, they are engaged in many governance actions at both the state level, certainly, but also at NAR. And Maren has been in very important committees at the National Association of Realtors. One of the things that we try to constantly pursue is the advocacy on behalf of the property owners, protection of private property rights. And recently during this pandemic, to say that realtors were very hardworking entrepreneurs, but due to the government imposed economic lockdown during this disruption, that the realtors should be able to tap into financial resource availability, whether as a broker, small business administration loans, which may not need to be paid back if you meet certain criteria. And for ordinary agents, the unemployment pandemic relief during this temporary disruption. So all the works by important committees, which Maren is very much involved in. Let me give you my assessment of how things are likely to play out based on the data that I have been looking at. So let me go into the technology and try to pull up my PowerPoint slide and share that with you. As an economist, we speak much better with the PowerPoint in hand. So let me do this. All right, there we are. So the first evidence of the economic disruption to the economy came from the Department of Commerce on GDP. GDP is the measurement of total economic activity in the US. And in the first quarter, which is January through March, and it would include the second half of March when everything shut down. And it fell 5%. And it fell 5% because consumer and business spending had collapsed 7% and 8% respectively. Look at the next line, residential investment. It increased 18% even as the rest of the economy were falling. And residential investment would comprise home building activity, home sales, remodeling expenditures. So this is implying just how strong the housing market had been prior to the pandemic. Essentially, January and February, very strong. March numbers were somewhat iffy because of the virus impact. But the first quarter, housing sector just exceptionally strong pre-pandemic. And the next line is interesting, which is the data for April. So after the first quarter, personal income during this economic lockdown and during the pandemic period for the country as a whole increased 12%. And you say, how is this possible when we have unemployment rate rising? Well, the people have lost job, whether permanently or temporarily, but the massive stimulus package, whether Small Business Administration loans, the action by the Federal Reserve, the unemployment insurance check, all has provided income support. So what is interesting is that as the income has been rising, there was no place to spend the money. We cannot go to the baseball game, we cannot go to the restaurant. So savings rate increased to 33% of people's income. It had been only 8% 1 year ago, which is implying that once the economy steadily reopens, and I believe North Carolina, you are in that phase 1 reopening or phase 2, but there may be some different definitions state by state, but there will be steadily more reopening throughout the country, which means that there is a spending power potential to be unleashed into the economy as people have been saving up the money. So let's see how that plays out. The pessimistic outlook is given the uncertainty, people may be just putting more money under the mattress just in case for the rainy day fund. And that will not help the economy. So hopefully as people are receiving stimulus checks, they are actually trying to stimulate the local economy by putting the money back into the local economy. If we look at the employment situation, the massive 20 million job losses that occurred in April, which should be no surprise. Essentially, government said, well, businesses have to shut down, especially in the leisure and hospitality sector. So hotel industry, Disney World is closed, airline industry, devastated during this lockdown. The second line is somewhat interesting. There were 2.5 million job losses in the healthcare sector, along with education. And I believe most of this job will quickly return because some nurses and doctors were actually laid off. And you say, how is that possible when we see the television images of coronavirus, the hospital beds, and all this situation where there are many people in the medical profession who are not involved in coronavirus. For example, a surgeon who specialized in hip surgery, they had to shut down, and they had to also lay off their nurses. The dental offices, knee replacement. So many healthcare issues were shut down during this coronavirus during the March, April period. So certainly people would need dental care. People would need that postponed hip surgery. So that job will immediately come back. Some jobs like retail trade may take longer, particularly restaurants. But the construction industry, we are short of housing inventory. We need more construction workers. So I expect nearly all of the construction job that was cut to be soon bouncing back to the positive. And here's the overall job numbers for the US as a whole. And you see that jobs number from year 2000 steadily increased up to 2007 before declining. That decline was related to the foreclosure crisis, subprime lending blowing up. Fortunately, we don't have those lax underwriting standards anymore, so we will not have a housing market crash as what happened, say, 10 years ago. But since the low point of the foreclosure crisis, it's the middle of the chart, we have seen 10 straight years of job gains. And then look what happened on the final data point, boom. 10 years of gain essentially lost in a single month. So a very discouraging situation, but government officials said it was required in order to contain the coronavirus and to assure that there is sufficient number of hospital beds and ventilators to assure every Americans would at least get the attention to care. Now, this is the chart for North Carolina. Looks very similar to the US, but if one was to look a little deeper into it, what you find in North Carolina is that it is a faster job creating state compared to most other states in the US. And that's partly due to many companies wanting to locate into more business friendly environment. whether it is the Raleigh Triangle region, Charlotte, or even people going to Asheville as a retirement home, or Wilmington, North Carolina. I visited Mount Airy once because my wife loves the Andy Griffith Show, so we had to see that. But the overall North Carolina has been outperforming compared to the rest of the country. And again, you see that big drop that occurred in the most recent months in terms of the job. But many of that job decline is temporary in nature, and it will steadily rebound as the economy reopens. Now, one evidence of that is people receiving unemployment check. So prior to the pandemic, so before mid-March, you can see that about 5,000 people in North Carolina were applying for unemployment insurance for the first time. And given the dynamism of the economy, there's job creation, job losses, about 5,000 people filing for unemployment each week. Then sudden surge from mid-March, but the recent data, final 3-4 weeks that you see, the number of new filers, about 50,000. That is still high, but certainly not as high as 200,000 that we have been observing. So you can almost view these new cases of unemployment insurance as almost similar to, say, coronavirus. We are flattening the curve because first phase of the turnaround is we have to flatten the curve, and then hopefully people recover. So at least the number of people who are getting laid off, the first timers are steadily beginning to decline. If we look at not new cases, but total cases, so how many people in total are receiving unemployment check, it looks like the following. So this is in essence adding up all the new cases. All the new cases that are coming in for unemployment check is rising. Again, please, realtors, tap into the financial resources that is available. Realtors do qualify for unemployment insurance check for the very first time ever. We lobbied very hard to assure that entrepreneurs were working hard, but it was government-imposed shutdown. So please tap into the resources during this disruption. But the good news here is that total cases of people filing for receiving unemployment check is actually declining in the past 3 weeks, which means that even though they are first-time filers, there is evidently job creation also occurring. We know that FedEx is hiring, Amazon is hiring, and certainly like dental offices are now going back to work. So this is a very good trend that the worst in the employment situation is already over in North Carolina. The question is, how long does it take to get back to normal, or how fast this number of people on unemployment check will decline? And I know realtor spirit, you want to have that commission check over the unemployment check, but it will take a little time. So hopefully during this disruption, at least you are getting some level of financial support. Now this is the map of the US, and let's just look into the state of Texas. First, it's easy to find. And then I want to contrast that with North Carolina. If you see Texas, it has $165. What is that $165? This shows that on average, someone who was laid off in the state of Texas now are receiving unemployment check that is on average $165 more per week than the wages they lost. So many people in Texas on average are actually better off unemployed than the wages they were receiving. If you look at North Carolina, it shows parentheses $36. So what this means is that a typical worker who got lost job in North Carolina is down about $36 per week compared to the wages they were earning. So it's almost replacement of most of the income, but not 100% of the income in North Carolina. By the way, this enhanced unemployment insurance benefit would expire end of July. And after that, everyone who's unemployed will be essentially much worse off compared to the jobs wages that they were earning. This is due to the fact that the federal government essentially added $600 per week on all the unemployment checks. So North Carolina, you are getting most of the income replacement, but not all. Now, the other policy for the federal government to help the current pandemic situation that's related to the economy is that Federal Reserve monetary policy, they are all in. The Fed funds rate that you see is the interest rate they sort of control in order to bring down all interest rates. And they're also pursuing something called quantitative easing, which means that they are buying corporate debt, mortgage-backed securities, with the intent, practical purpose of bringing the mortgage rates down. Blue line is the 30-year fixed rate mortgage rate, and it hit an all-time low of 3.2%. So we have a record low mortgage rates today. I mean, it may bounce, small amount, but essentially, effectively, the lowest mortgage rate ever in the U.S. The orange line that you see is the 10-year Treasury yield, what the government borrowing rate is. And you see that two lines pretty much move in sync, one, in a synchronized fashion. Look at the last data point. 10-year Treasury is under 1%, which means that mortgage rate could be even under 3%. So we are happy with 3.2%, but it's possible that in the upcoming months, the mortgage rate may actually decline even more. Just possibility, not a guarantee, because sometimes mortgage rate can do their own things. But given the larger than normal spread between 10-year and 30-year fixed rate mortgage, there's a possibility that mortgage rate may actually go under 3% in a month or two. One mortgage that is not working is jumbo loans. Jumbo mortgages cannot be purchased by Fannie and Freddie, and therefore it is not working. It's very tight conditions, and sometimes it requires 40% down payment, pristine credit scores, which is the reason why NAR has been advocating strongly about the importance of Fannie and Freddie. But fortunately, in North Carolina, most loans do fall under the conforming, and therefore it helps most middle-class families. In states like California, in New York, where jumbo loans are much more reliant, that's where the hurt is being felt related to the mortgage market. So mortgages at the historically low levels. Now, one complaint that I've been hearing from realtors across the country, or when I speak with Marin and other realtors in North Carolina, they've been indicating last year, housing market was great, but if we had more inventories, we would have done far better. Lack of inventory has held back the housing market potential in North Carolina. What happened during the pandemic? Even fewer listings in the marketplace. So we had a housing shortage before the pandemic, and the housing shortage worsened during the pandemic. We need more inventory to show up, and certainly for many people with secure employment, you are looking at about 70% of the population. 70% of the population would have secure job, and they are looking at record low mortgage rates. They want to buy a home, yet there's just not enough inventory, which is the reason why you are seeing multiple offers on many mid-price and starter home markets. On the very upper end, maybe there is sufficient inventory and maybe some price reduction may be required. But right now, we are short on inventory on the broad middle segment of the market. We need more inventory. The first evidence of the pandemic impact is the pending contracts. So pending contracts has been very healthy before the pandemic, and in the March, it declined 20%, then another 20% decline in April, which means that for closing activity, May figure may be the low. Related to pending contracts, we are already seeing improvement in the month of May, and certainly the trend will improve even more through, say, June and July, assuming we don't have a second economic lockdown, second wave of coronavirus. Dr. Fauci indicated that he believes that vaccine will be discovered this year. So let's cross our finger that vaccine can be discovered. But if it's not discovered and we are hit with the second wave of the pandemic, then some of the gains that we have seen in May and early June may all be reversed. So let's just hope for the best as related to containment of the virus. Now, very early indicator as to why I believe the housing market looks to be on a V-shaped recovery is this graph. People argue over, is it going to be V-shaped? You go down hard, but you recover very hard, fast. Or is it going to be U-shaped? You go down, it lingers on the bottom for a while before recovering. Other people say L-shaped. You go down, and then you sort of stays down for a while. And what this chart you see, just visually, it looks more like a V. So a housing market at least looks like a V-shaped recovery. Airline and cruise industry may be more like an L-shaped recovery, or restaurant business may be a U-shaped recovery. But certainly for the housing sector, it looks to be V. So what is this saying? People applying for mortgages, which is the very first step to buy a home. You always encourage your potential home buyers get a mortgage approval before deciding to look for a home. So people who are applying for mortgages to buy a home, before the pandemic, it was 10% higher compared to 1 year before. Then it collapsed 35%. But look at the recent weeks, it is up close to 20% higher compared to 1 year ago. So very, very solid recovery, high interest of people wanting to take out a mortgage in order to get into the market. So it's plenty of buyers in the pipeline ready to reach in. We need more inventory to fully satisfy this demand. And the supply situation, I don't think it will be quickly relieved because you see this chart on housing starts, which shows the new home construction. So the orange line is the historical average. So we actually overbuilt during the last housing cycle, which is the reason why we had that price decline. This time, we have been underproducing for multiple years. So any client who is worried about home price decline, you immediately dismiss that idea because we are short on housing shortage. And I thought that we are finally getting above normal. In fact, we need to be above normal to relieve inventory. But during the pandemic, home builders were shut down. So it went down again, which means that housing shortage will be with us for the remainder of the year and even the spring buying season in 2021. So please keep that in mind, especially if you're working with first-time buyers. There could be multiple offers, multiple competition among other buyers to get into the market because there's just not enough housing inventory to fully satisfy the rising demand. Federal budget deficit, wow, this big red, $4 trillion in 2020 anticipated. All this stimulus measure requires money. Unemployment check requires money. The economic disaster loans requires money. So the federal government is running a massive $4 trillion in deficit. Who is buying this debt? Is it the Chinese government? Is it the Chicago Teachers Union? German mutual fund? Who is buying this US debt? And currently, the major source of purchase is from the Federal Reserve. Chairman Jay Powell and the Federal Reserve Open Market Committee are essentially purchasing US Treasury debt. How are they getting the money? They're printing money. So in essence, all this unemployment check, you can say it is printed money by the Federal Reserve to get it out to the people. It is needed in terms of trying to stabilize the economy and also the reasoning to say that people are working hard, they should not face the economic hardship. So the printed money is coming along the way. But we should also be mindful of potential consequence. Economic textbook would say you print money, we will have inflation. And in the US, we are very fortunate to have a US dollar. We can print money and not have inflation, at least not right away. Why? Well, consider $20 bill. You take that $20 bill, go to Mexico or Vietnam or even Italy and say, here's $20 bill, give me a haircut. And they will give you a haircut for $20 bill. People accept the US dollar. Other currencies, people will be questioning, no, I'm not gonna accept that. But we have this historical role, US dollar being the world global reserve currency, that we can print money and not have inflation right away. So no inflation this year, no inflation in 2021, but at some point, because we have to print more money in 2021, given the situation, that at some point you said all this printing of the money may come up as an inflation. So 5, 6, 7 years from now, we may have higher inflation. People remember the 1970s when prices were rising about 10% a year. And prices of everything is rising. Food prices, gasoline prices, real estate prices. But one thing that will not be rising if we have high inflation is people who purchase home now locked in at low interest rates. Their mortgage payment will be completely fixed, independent of inflation. So something to share with your clients that once they lock in at those low rates, 5 years from now, their monthly payment will be the same. Maybe their salary is rising, which is good news, but everything else is more expensive, but the mortgage payment would not be rising. Something to consider, and certainly a possibility that you want to share with your clients. So let me go to the outlook. So the outlook is, this is a national forecast, like 5.34 million home sale in 2018, 2019. It doesn't mean too much for ordinary agents, but what it means is that numbers were very respectable home sales. Then in the first quarter, we were actually up 5%. Again, just to show how strong the housing demand was before the pandemic. But the second quarter will be down because of the disruption. I anticipate about 28% lower compared to 1 year ago. But the third quarter and fourth quarter will be down less severely. Steady reopening of the economy, more transactions, more listings. So that will be the sort of my guess as to how the economy will play out. I mean, there could be any external shock to this forecast. Maybe we don't have a severe decline because mortgage application is clearly implying that third quarter actually may be positive. But I want to be a little conservative. For North Carolina, whatever data point you see here, you can say North Carolina will do a little bit better just because you have a faster job creation compared to the rest of the country historically. Now in 2021, the last column, everything lights up. Positive economy, positive net job creation. Home prices for the country may be something like 1 to 3%, but in North Carolina, I think it will be easily closer to 5% over the statewide. And home sales, it will easily recover all the lost home sales that occurred in 2020. Essentially March, April, May, lost home sales, all that will be more than recover in 2021. And my final comment is, even if the vaccine is discovered, expect some permanent change. And one permanent change is the following. I have been doing the Zoom meetings continuously, whether it's a presentation or my office meetings, and people are getting very used to it. Many companies are in fact saying you can work from home forever, according to Twitter, and in Facebook most days. And I think many companies will also say, rather than come to office 5 days a week, you can now come to office 3 days a week. If that is the case, people do not need to live so close to the job centers. So they may be 1 hour away, 2 hours away, knowing that they don't have to commute every single day, which means that it may revive some of the housing demand in the suburbs, or even in towns which is not considered traditionally as a job center, say, Asheville, or say Fairfield, North Carolina, where the job creation has been more lackluster, but certainly much more affordable compared to Raleigh, North Carolina. So you may see some demand shift in these patterns. And if people need to work from home, maybe they need a larger house. So whatever homes they were currently living, they may say, well, I need a little more elbow space. So they could raise housing demand in the future due to this permanent change. And also consider many northern state residents. I mean, they have been moving into North Carolina, but they may still have a job in New York City, but they said, well, I want to work out of Charlotte. That type of situation will clearly be present going into the future, because I think people have become used to this virtual office meetings, and many companies will permit the situation. So let me just leave it at that and stop sharing this slide and turn it back to President Marin.
Hey all, and you get to see me with my nerdy glasses on too, right? Because my eyes are aging, staring at all these Zoom meetings and the screens. I can't see anything. With that, I want to say thank you. Thank you for your presentation and your information. I just eyeballing our chat just to make sure we don't have any. Yes, we will have all this available on a link on our website at NC Realtors for you guys, and it will have the PowerPoint as well. So thank you for meeting with us. I miss you, but hopefully I'll see you maybe in New Orleans in November. And with that, I want to say thank you all for your time and for logging on and to get your economic update. And everyone have a wonderful day.